Imagine this. You are sitting at your kitchen table, sipping your morning coffee, and you suddenly wonder, if something happened to me tomorrow, would my family be okay financially? That question alone has kept many people awake at night. Life insurance is one of those topics that feels complicated, boring, and maybe even scary, until you realize that it could be the single thing that keeps your loved ones from facing financial disaster. And here's the interesting part. Most people have no idea that there are different types of life insurance, each with its own pros, cons, and sneaky little details that can cost or save you thousands of dollars over time. By the end of this video, you will not only know the main types, but also which ones make sense for your life, your goals, and your budget. And there is one type that most beginners overlook, but it could be the smartest move you ever make. Number 1. Term life insurance. The simple option that works. Think of term life insurance like renting an apartment. You pay for it as long as you live there, but when you leave, you do not own anything. With term life insurance, you buy coverage for a fixed period, usually 10, 20, or 30 years. If you pass away during that time, your beneficiaries get a lump sum of money. If you outlive the term, the policy ends and there is no payout. This type is often the cheapest and simplest option. A 30-year-old healthy non-smoker might pay around $20 to $30 per month for a $500,000 policy. The catch: once the term ends, you have to renew at a much higher rate or let the coverage go. Term is great if you want affordable protection while paying off a mortgage or raising kids. Example: Sarah, a 35-year-old mom, takes a 20-year term policy so that if anything happens to her before her kids graduate college, they will have money for tuition and living expenses. Number 2. Whole life insurance. The forever coverage. Whole life insurance is like buying a house instead of renting. As long as you pay the premiums, it lasts your entire life, and it builds a cash value you can borrow against. The premiums are much higher than term life, but the policy guarantees a payout, no matter when you pass away. Here's the part most people do not know. The cash value inside the policy grows slowly at first, but can be used later for things like supplementing retirement income or covering emergencies. Example: Mike, 40, buys a whole life policy. By age 65, his policy has built up enough cash value for him to borrow against to pay off a small debt without canceling the coverage. Number 3. Universal life insurance. Flexible but tricky. Universal life insurance is like a choose-your-own-adventure policy. You can adjust your premiums and death benefit over time. It also builds cash value, often tied to interest rates. The flexibility is appealing, but here is the danger. If you underpay for too long, the policy can lapse, leaving you with no coverage. Example: Karen starts with high premiums in her 40s, but lowers them when she hits 55 to free up cash for travel. She has to carefully track her policy so the cash value doesn't drain to zero. Number 4. Variable life insurance. Investing inside your policy. This type lets you invest the cash value in mutual fund-like options. The upside: if investments perform well, your cash value and death benefit can grow faster. The downside: if the market tanks, your policy value can drop. This means it is riskier and better suited for people who understand investing. Example: Tom puts part of his variable life cash value into stock funds. In a good market year, his policy's value jumps, but in a down year, it takes a hit. Number 5. Final expense insurance. Small but powerful, also called burial insurance. This is designed to cover funeral and end-of-life costs. Coverage amounts are usually small, like $5,000 to $25,000. But it can be a lifesaver for families who might otherwise have to put expenses on a credit card. Example: Linda's final expense policy covers her $12,000 funeral cost, so her children don't have to scramble for money. Number 6. Group life insurance. The workplace perk. Many employers offer group life insurance as part of their benefits package. It is often free or cheap, but the coverage amount may be low, like 1 year's salary. The big risk: if you leave the job, you may lose the coverage. Example: John gets free group life through work, but he also buys a small term policy on his own, so he is covered if he changes jobs. Number 7. Guaranteed issue life insurance. No questions asked. This type does not require a medical exam or health questions, making it a last resort for people with serious health issues. Premiums are high and coverage amounts are low. often. There is a waiting period before the full death benefit kicks in. Example, Mark, who has a major heart condition, gets a guaranteed issue policy so his family can at least cover funeral costs. Number 8. Indexed Universal Life Insurance. Growth tied to the market. This works like universal life, but the cash value growth is tied to a stock market index like the S&P 500. The insurance company usually sets a cap on gains and a floor that protects you from losses. This means your money can grow more than in a fixed interest policy, but without the full risk of investing directly in the market. Example, Rachel's policy earns 6% in a good year because of the index performance, but in a bad year, it earns 0 instead of losing value. Number 9. Survivorship Life Insurance, covering 2 lives, also called second-to-die insurance. This covers 2 people, usually spouses, and pays out only after both have passed away. It is often used in estate planning to leave money for heirs or cover estate taxes. Example, Robert and Emily use survivorship life insurance to make sure their children inherit the family home without having to sell it to pay taxes. Number 10. Accidental death and dismemberment. The extra layer. This is not traditional life insurance, but pays if you die or lose a limb in an accident. It is cheap, but it only covers specific events. It is best used as an add-on, not your main coverage. Example, Steve adds AD&D coverage to his term policy for a few extra dollars per month because he works in a risky construction job. Number 11. Choosing the right policy. The big question. The best type of life insurance depends on your goals, budget, and stage of life. Young parents with a mortgage often go for term life. People with long-term financial plans may prefer whole life or universal life. High net worth families might use survivorship policies for estate planning. The key is to match the policy to the financial risk you are trying to protect against. Ask yourself, what debts do I have? Who depends on my income? How long will they need support? Number 12. Common mistakes to avoid. One mistake is waiting too long to buy. Premiums rise sharply with age or health problems. Another mistake is buying too little coverage. Your loved ones may end up short. Overbuying is also a trap if you cannot afford the premiums long-term. Example, a 25-year-old might lock in a 20-year term for pennies compared to what a 45-year-old would pay. Number 13. The overlooked option that can be a lifesaver. Many beginners do not consider a mix of policies. You can combine a cheap term policy for big coverage now with a small whole life policy for lifelong protection. This hybrid approach can give you the best of both worlds without breaking your budget. Example, Jessica takes a 20-year term for $500,000 plus a small $25,000 whole life policy. The term covers her mortgage years, and the whole life stays with her forever. Number 14. Convertible Term Life Insurance. Turning temporary into permanent. Convertible term life insurance starts as a regular term policy, but it gives you the option to convert it into a permanent policy without taking another medical exam. This is helpful if your health changes or if you decide you want lifelong coverage later. Example, Kevin buys a 15-year convertible term policy in his 20s. At age 34, after being diagnosed with a chronic illness, he converts it to whole life so he can keep coverage without paying much higher rates. Number 15. Joint life insurance. One policy for 2 people. Joint life insurance insures 2 people under one policy, but pays out after the first person dies. It can help the surviving spouse cover immediate expenses, debts, or income loss. Example, Anna and Paul buy joint life insurance, so if one passes away, the other will have money to pay off their mortgage and handle household bills. Number 16. Credit life insurance. Protecting a loan. Credit life insurance is designed to pay off a specific debt, like a car loan or mortgage, if you die before it's paid. It usually costs more than regular term life for the same benefit, but it ensures your loved ones are not stuck with the debt. Example, Lisa takes credit life insurance for her 5-year auto loan, so her family will not have to make payments if she passes away unexpectedly. Number 17. Mortgage life insurance. Keeping the family home. This policy is tied to your mortgage balance and pays it off if you die during the loan term. It is different from credit life because the payout goes directly to the lender, not your family. Example, David buys mortgage life insurance so his wife will not have to worry about making house payments if something happens to him. Number 18. Supplemental life insurance. Boosting your coverage. Supplemental life insurance is extra coverage you can add to an existing policy, often through your employer. It is useful if your base coverage is too low, but you want a quick way to increase it without a separate application. Example: Maria's employer covers her for $50,000, but she adds a supplemental $150,000 to make sure her kids' college costs are covered. Number 19. Decreasing term life insurance. Coverage that shrinks over time. This type of term insurance has a payout that decreases as the years go by, usually matching a shrinking debt like a mortgage. Premiums are often lower than level term policies. Example: Jack takes a 20-year decreasing term policy that drops in value each year as he pays down his home loan. Life insurance is not about you. It is about the people who will still be here after you are gone. The right policy can mean the difference between your loved ones being secure or struggling. So, if something happened to you tomorrow, what kind of safety net would be there for your family?